You've probably heard the phrase, the S&P 500 on the news 100 times. The S&P 500 closed up today. The S&P 500 hit an all-time high. But what actually is it? And more importantly, should you be putting your money into it? In this video, I'll explain exactly what the S&P 500 is, why it's considered the benchmark for the entire U.S. economy, its historical returns, the risks, and whether it deserves a place in your portfolio in 2026. Let's get into it. The S&P 500 stands for the Standard & Poor's 500. It's an index, basically a list, of the 500 largest publicly traded companies in the United States. We're talking about companies like Apple, Microsoft, Amazon, Nvidia, Google, Meta, Berkshire Hathaway, Johnson & Johnson, ExxonMobil, and hundreds more across every industry: technology, healthcare, energy, finance, retail, you name it. These 500 companies represent roughly 80% of the total value of the entire U.S. stock market. So when people say the market is up or the market is down, they're usually talking about the S&P 500. It's not something you can buy directly. It's just a list, an index. But you can buy funds that track this list, like VOO or FXAIX, which I covered in the last video. When you invest in an S&P 500 fund, you're not betting on one company. You're betting on the collective success of the 500 biggest, most successful businesses in America. Now let's talk about the numbers, because this is where it gets exciting. Since its inception, the S&P 500 has returned an average of approximately 10% per year. That includes dividends being reinvested. Now, 10% per year doesn't sound dramatic, but let's see what that actually means with compound growth. If you invested $10,000 in the S&P 500 in 1990 and just left it alone, by 2026 that would be worth well over $200,000. That's the power of long-term compounding. But here's the thing, that 10% average is not a straight line. The market doesn't go up 10% every single year like clockwork. Some years it's up 25%. Some years it's up 30%. And some years it drops hard. In 2008, during the financial crisis, the S&P 500 dropped about 38% in a single year. In 2020, during the COVID crash, it dropped over 30% in just a few weeks. In 2022, it dropped about 18% due to inflation and rising interest rates. But here's what's important. Every single time the market has crashed, it has eventually recovered and gone on to hit new all-time highs. Every single time. The 10% average return includes all of those crashes. It's the average over decades, not a guarantee for any single year. I want to be honest with you about the risks, because too many finance videos online act like the stock market only goes up. Risk 1. Short-term volatility. If you invest in the S&P 500 and need that money in the next 1 to 3 years, you could lose a significant portion of it if the market crashes at the wrong time. The S&P 500 is not a place for short-term savings. Risk 2. Emotional decisions. The biggest risk to most investors isn't the market itself. It's panic selling during a crash. People who sold during the 2008 crash or the 2020 crash locked in massive losses. People who held on and kept investing recovered everything and then some. Risk 3. It's U.S. focused. The S&P 500 only includes U.S. companies. If you want global diversification, you'd want to add an international fund like VXUS alongside it. Risk 4. Concentration in big tech. As of 2026, a small handful of massive tech companies make up a significant portion of the S&P 500's value. If those companies underperform, it can drag down the entire index more than people expect. None of these risks mean you shouldn't invest. They just mean you need the right time horizon and the right mindset. So, should you invest in the S&P 500 in 2026? Here's how to know. You should invest in the S&P 500 if you're investing for a goal that's at least 5 to 10 years away, like retirement. You can handle seeing your account drop 20, 30, even 40% during a crash without panic selling. You want a simple, proven, low-cost way to grow wealth without picking individual stocks. You should not put money in the S&P 500 if you need this money within the next 1 to 3 years. You would panic and sell everything during a market crash. You haven't built an emergency fund or paid off high-interest debt yet. For most people in their 20s, 30s, and 40s, building long-term wealth, the S&P 500 is one of the simplest, most proven wealth-building tools available. It's not exciting. It's not a get-rich-quick scheme. But historically, it works. If after everything I just said, you're ready to invest in the S&P 500, here's how. You can't buy the S&P 500 directly, but you can buy a fund that tracks it. The two most popular options are VOO, the Vanguard S&P 500 ETF, and FXAIX, the Fidelity 500 Index Fund. Both have expense ratios under 0.05%, meaning fees are almost nothing. Open a brokerage account, ideally a Roth IRA for tax-free growth. Search for VOO or FXAIX and buy. Set up automatic monthly contributions and let time do the rest. I covered the full step-by-step process in my earlier video on how to invest your first $1,000. Link is on screen now if you missed it. Quick recap. The S&P 500 is a list of the 500 largest U.S. companies and is widely considered the benchmark for the U.S. stock market. It has historically returned about 10% per year on average, including crashes and recoveries. It's a powerful long-term wealth-building tool for anyone with a 5+ year time horizon who can stay calm during downturns. You invest in it through funds like VOO or FXAIX, ideally inside a Roth IRA. Next up, watch my video on compound interest and how it can turn small, consistent investments into massive wealth over time. It's on screen right now. Free beginner investing checklist is in the description below. See you in the next one. Subscribe for more financial video